You check out energy prices this morning. They have come down over the last couple of days. If you're looking at WTI, this morning WTI trading at $95.43. That's a significant decline. It's well below $100. And this is happening as we are seeing some demand destruction. Joining us right now to talk about it is Damien Courvalin, who is Goldman Sachs head of energy research. And Damien, the demand destruction we're talking about, people using less gas at this point, and we're talking about gas, the price that they're paying, gasoline, what they're paying at the pump for these things. U.S. usage down by about 8%. So that's the demand destruction. Higher prices tend to cure high prices, whether that be through the supply picture or demand. And it looks like demand that's getting cut. How long do you anticipate that will last?
Yeah, as you point out, we have seen a demand adjustment in the gasoline market, especially in the U.S. Now, keep in mind, that's a response to record high prices that have since significantly come down. We think that maybe demand weakness is actually overstated in the data. So at current retail prices that are still declining, we'd actually expect to find back some demand. Remember, this process works both ways. Now, the key question then is, has the increase in prices been enough? And our take, when we look not only at the U.S., but on a global scale, is, look, demand for oil is still above supply. And so we're still depleting record low inventories. And so the move in prices that we've seen, especially the retrenchment, effectively is slowing the necessary rebalancing. And in our view, sets the stage for higher prices in coming weeks, unless the economy is about to abruptly slow. But we don't see that happening so far.
I think that's the big question. That's what we're looking through in every earnings statement. Hearing from Verizon today, even hearing from American Express, which had great numbers for the quarter, record spending, something like 30% increases in consumer spending on their Amex cards, but Amex still taking and setting aside credit losses for $410 million for the slowdown that they're anticipating, too. Things look great in the moment, but just about every company is worried about what's coming in the next 3 to 6 months. Why do you think that slowdown won't be as severe as some of these other companies are kind of anticipating?
Yes, I think there are a few points. First of all, as you stated, right, in the moment, demand is still good. And commodities are in the moment markets, right? The issue we have is today's or the very near term supply and demand, especially, as I said, in a world where we don't have the usual inventory buffer to smooth out the system, right? So if in the moment demand is still good, and that's what we find when we look across countries and across forms of demand, and that's today's challenge. That's the case historically in a recession, right? Think about 2008. We were beyond 6 months into the recession, and oil prices were still rallying to record high. Because the issue there is not about future growth rates, it's about today's imbalance. Now, eventually, of course, if we do have a sharp slowdown in economic activity, of course, this will help for some time resolve the oil deficit. But I think there are two challenges here. The first one is, that's still not guaranteed. Sure, there is a slowing growth, tightening financial conditions, but so far, our view is the odds of recessions are still below 50%. Second, even a recession, if it occurs, hasn't resolved the energy shortage that we face. This is a decade in the making, a decade of underinvestment. And if you slow demand through tightening of financial condition, as soon as you pull that restraint back, demand recovers and you're exactly at the same constraint on energy. So I think that's the second horizon, right? There's the short term, we think, higher move in prices, but there's also a multi-year move here, which is sustain likely record high prices to finally get those trillions of dollars of investment migrating. In fact, compared to 2008, right, we had record high prices after 10 years of investment in oil supply. Today, we may end up with record high prices after 10 years of underinvestment. The challenge is much greater from here.